Since 2008, we are witnessing a gigantic experiment in economic policy. The world's major central banks have been keeping key interest rates at extremely low levels and have flooded our economies with money. Ever since the financial and economic crisis started, central banks have brought into circulation an additional 10,000 billion US dollars, or an equivalent of 8,000 billion euros. Central banks have lent this fresh cash to commercial banks and to countries by buying their sovereign bonds. This increased the central bank's balance sheets. By mid-2013, the size of the US Federal Reserve Systems, that's the Fed's balance sheet, amounted to 3,385 billion US dollar, while the European Central Bank reached 3,314 billion US dollar, an equivalent of 2,550 billion euros. The Swiss National Bank was the most aggressive of all national banks. Between 2008 and 2013, its balance sheet grew by 483%. At the height of the crisis, the Swiss National Bank purchased large amounts of problematic assets from UBS, the largest Swiss commercial bank. In addition, to stop the revaluation of the Swiss franc, it sold almost unlimited amounts of Swiss francs in exchange for other currencies. In 2013, the balance sheet of the Swiss National Bank amounted to almost 84% of Swiss GDP. The US Federal Reserve and the Bank of England ranked second. Since 2008, the Fed's balance sheet has grown by 287%, and the Bank of England's balance sheet by 266%. The balance sheet of China's central bank has also expanded substantially, showing an almost threefold increase since 2008. In 2013, it already reached 54% of China's GDP. The balance sheet of the ECB, on the other hand, has merely doubled since 2008, with an increase of 119%. However, relative to economic performance, the ECB's balance sheet is larger than the Fed's, as the ECB's balance sheet reaches 26% of Eurozone GDP, while the Fed's balance sheet is merely the equivalent of 21% of US GDP. Unlike the Fed and the ECB, the Bank of Japan has already been pursuing an expansive monetary policy for more than 2 decades. Against this backdrop, the increase of its balance sheet by 89% since 2008 seems modest. This is expected to change dramatically in the years to come, because the Bank of Japan plans to increase its balance sheet from the current 36% of GDP to 60% of Japan's GDP. Overall, central banks reacted very swiftly to the crisis of 2007-2008 by providing massive amounts of fresh money to banks, nations, and parts of the real economy. At the beginning, all efforts revolved around avoiding the mistakes made during the 1930s and the world economic crisis. This approach turned out to be a good choice. Most countries were spared a large crisis comparable to the one of the 1930s. However, at least 2 problems remain. Problem number 1 is that while large amounts of cheap money buy time, they cannot replace structural reforms. Problem number 2, over time, this extremely loose monetary policy becomes less effective. The fact, for example, that lending rates for businesses and private households vary greatly throughout the Eurozone shows that parts of the additional central bank money does not reach its intended beneficiaries in the real economy. This is also related to the fact that today banks are much more reluctant to grant loans. Instead, they use part of the cheap money provided by the ECB to purchase government bonds. Last but not least, there is another danger that must be taken into account. Despite the fact that the Fed and the Chinese central bank already gave hints to reduce the glut of money sooner or later, it will be very difficult to sterilize the greatly inflated money supply overnight. This clearly implies the risk of higher inflation. Central banks claim to be in control of this risk. However, we live in times of high public debt in the US, in the Eurozone, and in Japan. In addition, we are seeing very high levels of private debt in countries such as Spain, the Netherlands, or Great Britain. It is therefore not clear if all parties involved believe that higher inflation really is a problem. Some of them might rather see inflation as a solution that would allow for a part of the huge debt to gradually disappear.